This week, we are coming out with 4 interesting webinars. The first webinar is Save Your Progress, where we will be discussing on how to protect your investment in tough market time and how to progress through it. And the second webinar will be hosted in Tamil language, where we will be discussing on what time frame your investment need to be evaluated. And the third webinar is Gold, a shining opportunity, where we will be deep diving into the risk and reward involved in the asset class gold. And the fourth webinar is the top 7 risks need to be avoided in a bull market. If you are interested in any of these 4 webinars, you can click the link below in the description to register.
Every fund manager comes with his own set ideas, set philosophy, and well established process. But the market context keeps changing dynamically. Fund managers generally change much slower than the market context changes. They believe that with their own approach, they would still be able to do better than the market and need not really worry too much about the market. This confidence can be both good and bad, because sometimes when you need to change quickly, you may end up not changing quickly. That's the bad side. But the good side is you are more in control of what you do, and with the highest conviction you do everything that you do. So that's the good side. Generally, what we have seen, and we have seen the multiple managers who have done multiple cycles, they underperform for a few years. All of us tend to write them off, and then suddenly, like a bolt from the blue, in just 1 year or 18 months, they perform so well that they compensate for those years of underperformance and even do better or do more. This is true of even individual investors. I have seen so many market cycles where some of us with a particular style of investing would keep exchanging notes and find that some others who are more adventurous are outperforming us by miles. But there are some people who are cool headed like Dhoni, who will say we'll do it in our pace, our way. And generally, if you stick to that, my experience is it does work out. So changing course, for some of us at least, is not a great idea. Every investor has a certain orientation, and today we are going to discuss with Subra about how this orientation of an investor can be different, and yet different styles have a space in this market and in every market. Subra, what are your thoughts on this?
See, what happens for a fund manager after he spots a good share and he buys a little bit, he is completely unable to buy more and more because the floating stock vanishes. A case in point is something like Nippon Asset Management. There is no way how a big fund can buy more of those shares. They are just not available. So if he wants to buy an AMC share, he has to now go back to some other AMC. He cannot buy this AMC simply because it's not available. Similarly, for an individual, it is easy to build small positions, 200, 500, 1000, maybe 5000. But for a fund house, this is going to be very difficult. Second, the fund manager has to create the story as to when he is buying, why he is buying, how much he is buying, and when he will sell, and that he has to give it to the trustees. He cannot keep on buying, or he cannot keep on holding even beyond the target price. He will have to create further and further stories. The individual doesn't have to do that. So building a position, something like even Bharti Airtel or State Bank of India, building a big position takes a long time. The kind of position which HDFC or an ICICI built in this takes a long time to build, maybe 2-3 years to build and 2-3 years to exit. They cannot come in and come out so easily, right? Second, they can't trade. They got those restrictions that you have to buy on a Monday and then you have to wait till at least Thursday, Friday before you are able to sell. So they can't trade. That is again an advantage for the individual. The other thing is when you report to many people as to what you are doing, creating that buy note or that sell note is not easy for the fund manager. And he has to, if not hug the index, at least be very close to the index. So if you take a view that you are running a large cap fund, but you want to be more risk averse, so you will not buy Ambani and Adani, this is good for an individual saying, okay, I will not buy these shares. But if a fund manager who is hugging the Nifty tries to do that, he will underperform the Nifty by a mile. Because these two funds have done well in the last, say, 1 month or 2 months post-elections, if they have done well. So those are some of the limitations of a fund manager. Even more importantly, today a big fund manager can have his way with the trustees and the directors. But when you're a young fund manager with conviction, you have to have the buy-in of the trustees, the directors, your CIO, everybody. That is not easy for a young fund manager. So amidst all this, he has to emerge and become a good fund manager. Those are big challenges.
But what about this? I'm more keen to know from you about the philosophy-driven investors. Like you have seen that some fund managers, and especially the ones who have been in the market for multiple cycles, like a Prashant Jain or an array, multiple people are there. Now they stick to a certain philosophy. Prashant stuck to public banks and public sector for such a long time, and 4-5 years it looked like it was not working. But post-COVID, in fact, even after he has left, the team has taken off like anything. But sticking to the philosophy is actually what has delivered that outcome. He didn't go and buy Adani because this is not working. I'm just giving an example. Just since you gave that name, he didn't leave this and suddenly go and buy, let's say, Bajaj Finance and make it his new engine of portfolio performance. And he didn't take the philosophy from value straight into growth at expensive valuations or buy at.
Yeah. No, I'm saying the 2022 Prashant Jain had already arrived. So when he sat and said this to, say, his chairman and his board and his trustees, they heard him. They listened to him. Think of the 2002 Prashant saying the same thing. He was a kid. Right? By fund management standards, he was a kid. He must have been in his 30s. At that stage, to have the conviction, have the portfolio and convince his board and his trustees and his chairman that this conviction will work would have been far more difficult for us as individuals. Actually, for me as an individual, I don't have to explain this to somebody on a daily basis for 5 years.
That is true.
He would have done that when he was 30 years of age.
No, but today it is even more difficult actually. If you see, today I am just telling you. So fund managers who have succeeded to a certain philosophy also, in small cap, mid cap, they know very well that today they cannot sustain that performance in that fund. So quietly they leave and go to either another fund or start their own fund. But that portfolio, which has run to a certain philosophy, probably has to change. I am giving you the other extreme. But the new guy, if he says I am going to change the philosophy, he will have outflows. So he will be forced to actually stick to that philosophy when he should not stick to.
Correct.
Right? Similarly, assume there is a younger person in his 30s who is today managing a value fund and sticking to value most of the time. And he is not doing as well as, let's say, a small cap fund, or somebody is doing an FMCG fund, some other fund which is not performing as well. He will have much more difficulty today convincing his key stakeholders, trustees, CIO, board, and then sales guys, and then the end customer, that what he is doing is actually right. It's just that there is going to be a kind of a return holiday, maybe for 12 months or 18 months or 24 months, and that whatever time you give now, the returns will compensate the subsequent period for this time. But today, how many people actually have the conviction to tell that in a product? Because as far as I see, in the most successful products of today, people did not have the same conviction to tell the investor. Fund managers did not have this conviction which they have today 24 months back or 30 months back to talk about PSU. I remember talking to a PSU fund manager, and I was telling him that he was buying businesses which are having a greater lag, and he should buy more policy driven businesses, which means defense and other things. At that time he was unwilling to actually be true to that label. He was trying to hide in some companies, try to do something which is just maintenance so that he doesn't have draw down, he doesn't underperform his benchmark. Whereas the opportunity then was to outperform the benchmark. And he hadn't too many investors, he had barely a few hundred crores. But still, he didn't have the open mind to buy new ideas, position them correctly. Like, at the time it was very difficult to convince this fund manager to buy a mass doc. As simple as that.